You know, it's a great question that I get on a weekly basis from people that are either retired or really close to it, is debt. Should I be out of debt completely? That's a very, very interesting thing to me because it obviously changes over time based on interest rates. But I've been doing this for almost 25 years now. And so for a very, very long time, interest rates were extremely low. So a common question I would get is, well, should I pay off my mortgage, or should I get a car loan, or should I do this, or should I do that? My advice when it comes to debt, and I think most investment advisors should probably just look at, obviously, big picture. But in the past, interest rates were really, really low. And one of the things that we would look at when it came to financial planning would be this idea of, well, what if you're sitting down with a couple, and let's say they're 70 years old, and they want to go buy $1 million house. And they come to me and they go, well, Mike, should I pull money out of my retirement accounts, or should I do this, or should I do that? Well, interest rates used to be really, really low. And let's leave out, big mortgages and everything else. Let's just say that they could borrow money at 3.5%. On $1 million and get a 30-year mortgage. Sounds a little bit crazy, right? So you're 70, you're going to get a 30-year mortgage. I mean, are you really going to live to be 100? Here's the reality in that scenario is it didn't matter, right? It was cheap money, and you got to live in the house over that period of time, and you didn't have to commit your $1 million of savings to a particular lifestyle. And it was kind of neat because we knew that you would probably pass away before paying off the mortgage. And what was the worst case scenario? The house would just go back to the bank, and then maybe your kids or your beneficiaries would have to figure it out later. But the point was you had a lifestyle, and somebody else was going to figure it out later, whether it was the kids or the bank or what have you. So now things have evolved or changed, and interest rates are pretty high. And so if you're talking to an independent financial advisor and you have questions about debt and should I carry debt into retirement, I think that conversation should probably take a little bit of a different spin in the sense that, well, do you want to borrow money to buy a car? I don't know. Maybe there's a manufacturer that's offering a really good deal, and maybe it doesn't make any sense to take on debt to loan money for a car. Maybe they'll give you that 0% rate or something for 60 months. That's not so bad. But what if it was a vacation house? What if it was your primary residence? What if, all of these things? Well, interest rates have actually gotten high enough to where when you go back and you look at what you could expect on an average investment return over time, maybe it was a 30-year mortgage, what could you expect? Borrowing money at 6% or 7% or 8%, maybe doesn't make as much sense. But what I love about the financial planning process, and what any independent financial advisor should be able to do for you, is walk you through the process, put together a plan, and just show you the difference between, well, what if I took money out of my retirement savings and went ahead and paid for it, versus what if I borrowed money to make it happen? And what does that look like for me over time? That's what financial planning is all about, and that's what independent financial advisors are supposed to be doing for their clients. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.